So let's go over and take a look at it. So we had the Fed bump rates down yesterday by 25 basis points. So that came out at 2 o'clock. So let's look at the 2 o'clock into the close to where we're at currently right now. We're currently ticking at 67.1050. So the rate announcement came at 2 o'clock yesterday at this level. So we had the rate announcement, Fed bumped down 25 basis points. Really wasn't a surprise in the market because everybody was anticipating that the Fed was going to bump down 25 basis points. If there's going to be a surprise, 50 basis points, this market probably would have rallied really hard yesterday. But, buy the rumor, sell the news. That's exactly what they did. Let's see how we can take advantage of news events, though. It's very important to look at these deeper liquidity grabs when there's news events. What does that mean? So we have 3 levels on the liquidity grabs. We have our proprietary SIM Renko Algo. It's called the SIM Renko Algo Deep Liquidity Grab Zones. And these are very important because it lets us know where the rolling position traders are going to get caught and lets us know where that we got possible reversals in the market that's going to happen on deep retracements. So let's take a look after the Fed and what type of opportunity we had yesterday with the rate announcement. There we go. So there we go. SIM Renko Algo Deep Liquidity Grab Zone. So you can see we have the 2 zones that we show in the room. You can have these on your own charts. Now, this is a 1135 Uni Renko chart. I can show you now. I don't have enough space to show different Renko sizes in the trade room, but you can change this to any Renko size you want. In other words, if you want to get pulled in, what this means is the market's got to reverse 35 ticks inside the zone before it's going to print a buy or sell signal. You can change this down to 12 if you want, 15, 20, 25, whatever you want. And I'll show you how to do that in a second. And you'll have more reversals inside of these reversal zones. So you just change this last number, the tick reversal, to, whatever you want. And I'll go over that in a second, how we do that. But these zones are stagnant, are not stagnant, but these zones will not repaint. So these zones today, you can see, I can tell where my deep liquidity grab zones are going to occur. I got confluence down here between 63 to 67 this morning, and I got confluence at liquidity grab zone from 89.5 this morning to 93. So what we'll want to see is you'll want to see the market come inside of these zones and then get a reversal. So let's take a look at it. Let's go from 2 p.m. Fed announcement into right now. It's 8:25 on Thursday, the 19th, right after the Fed. So let me get a big arrow. I'm going to show you how we do this. These zones are very, very accurate. So what we want to do is we want to be patient and let the market come into the zone and get a possible reversal. So here's the Fed announcement. So the Fed comes out. We get into our first zone here. I have a 100 zone and a 200 zone. Now the 3 zones we have in the room, we have a standard 25 zone, which I'll show you in a second. And then the deeper zones, we have a 100 zone and a 200 SIM Renko Algo zone. So these automatically come up for you on any market. This works on any market across the board. But those are 3 main liquidity grab zones where we're looking for the market to pull back, grab liquidity, and move out of that zone. The rules are, the first one came right at 2 minutes after the Fed announcement. It got into the zone. So you want to come inside the zone, and then you'll want to reverse outside the zone and then see a move up. That was a 13-point move. right at 2 minutes after the announcement. We come back down, break the zone, no trade. It's got to reverse inside the zone. Come back down, reverse inside the trade. Came back up, got outside of it, no trade, no trade. Comes back up inside of it. We get a sell signal up inside the zone. Here's our sell signal. There's reversal. This happened at 2:28, about 28 minutes, right before Powell came out and spoke at 2:30. That's typically when you see a nice big move in the market, and that occurred at 6,666 and went all the way down to 6,610 for a 56-point drop in the S&P, and our zone caught it. It came down after Powell spoke, reversed, but here's a good one right there. Even if you miss this one, if you're scared of taking the zone right before the Fed Powell spoke at 2:30, you like this break retest because you don't have to look at the color of the zone. It's just a break retest inside the zone. This was my favorite one of the Fed announcement right there. Why? Because it was confluence. If you notice, my 100 and 200 zone was overlapped. You can see it just underneath it. I have my 200 zone and my 100. They're overlapped. So you can see them overlap. That's called confluence. What the market did, it broke through it. It retested it. Never closed above it. This is your best sell signal after the Fed announcement. And it caught that big move down. This is the favorite one right there. 40 on the 1-135 chart is 46.5 all the way down to 11 for a 36-point move on the S&P. And that's for 1439 to 1455. Only in 15 minutes for that big move. Market comes up and this is a key zone for the rest of the session. You can see why. If I skinny this up, you can see why it was a critical level. We come back up right around 3 o'clock. We're into that power hour trade. Power hours in the morning and power hours in the evening. Power hours categorized as 9:30 to 10:30 in the morning, and then 3 o'clock to 4 o'clock. I love the 3:50 to 4 o'clock push in the market they like to do, the institutional traders. But you see, we got inside the zone, then it went the other way. We got inside of the stack zone, came up, retested inside the zone, didn't close below the zone at all, held it, gave us a reversal. That's one. This one came down, did not qualify as a trade, but it came up again, reversed, got another one here at 3:20. So we had one at 3 o'clock, one at 3:20, another nice trade. 6,662 and a quarter, got as high as 76. Another 14 S&P point move, but then it caught it at the close. Man, did it catch it at the close. Came down to it. This is why you don't want to take shallow retracements. There's garbage in here. This is garbage. Shallow retracements. It came right into our deep retracement zone, confluence, and it got another one. It was just a beautiful Fed day yesterday. If you traded the Fed in the afternoon and you traded the system, you did very, very well, because if you're trading the deep zones, you caught that deep zone right there in the power hour, and 662, and it rallied all the way into 93, almost 30 S&P point move. So you can see what they like to do. If you look at the zones after the Fed, you have multiple opportunities. Caught that big short. Caught this big retest short. This is one of my favorite ones right there. And then caught the retest longs at that level and that level. So what you don't want to do, since these zones are so accurate, if it breaks the zone and it's breaking through the zone, you don't want to get into the trade because it may go down to the next zone. So if it's not going to reverse, then you don't want to play it. Okay. Now you can change your reversal size. So this is a 1/135. You can change your reversal size. So let's say I want to go back down to, let's take a look at, just getting this down yesterday. And let's take a look at these sells yesterday with the Fed. This is our 125.25. Let's just take a look at it. So after the Fed came out on our 120.25, the market dipped really good. So this is our more shallow zones, right? This is our 25 sell zones. So let's take a look at only the yellow triggers, the yellow trigger entries. We have our 25 buy zone that you could have got right there from 73 3/4 to 86, 13-point move, right? Because you're green right there. You came inside of it, reversed. Let's just look at the yellow triggers though. The yellow triggers can be adjusted to smaller Renko sizes. So if you look, you got a yellow trigger here, 1335, 1439, 1441, and then 1444. And then we got the big move up, 1501, 1503. Let's take a look at this and look at the difference in if you want to change your Renko size. So let's skinny this up just to see the close so you understand what this means. So this is an entry on the 1/135. This is 66.52. Got a size 62 for a 10-point move. 55.05 to 72 for a 17-point move potential and so on. So what you can do is you can change, let's say you change your Renko size. What's that going to do to the trigger entry? It's going down to 1/112. By changing the tick reversal, what you're doing is you're allowing to get in early. So when the Fed releases, what it's going to do is going to give you more trigger points on entry. What does that mean? So now let's take a look at the chart. Look at where the arrows are, the red arrows and the green arrows after the Fed. You're going to get multiple opportunities now. You're going to get more opportunities. So you can dictate if you want to see more yellow trigger entries inside of the zone just by shortening your Renko size on a reversal. Now, instead of reversing 35 ticks up before you get a yellow trigger entry, it just reverses 12 ticks up. And if you're inside the zone, it's going to give you a trigger entry. 3 o'clock, you gave it at 26 3/4. Where the 35 would be up here, you got target 1, target 2, possibly 3 off. So you're going to get more entries with smaller stops. You're just going to get a lot more entries. The reason we show 1/135 in the room, we can't show all the Renko sizes, obviously, with our viewer. We don't have enough room to show multiple Renko timeframes or Renko sizes. So find one you're comfortable with. If you're more of a scalper and you like scalping, this is what you want to do. You want to go to a smaller Renko size with very small stops. If you're a position trader, you want to go with the larger Renko size, meaning you're trying to position trade for a 10, 15, 20 possible point move. But if you look when you're going into a smaller Renko, when you go into the smaller Renko inside the zones, you're going to get multiple opportunities. And this is just an example. I wouldn't go lower than a 1/112, but just shows you. And then you can go into the medium level if you want to go, let's say at 1/120. You don't have to do a 1/135 is what I'm saying, is that you can find The zones are key. The zones are key to finding reversal points. The key is the zones are not going to change. See, the zone is not going to change. The zone is not going to change. The zone is not going to change. The zones are going to stay the same. It's your entry trigger that's going to change. So if you're looking at keeping tighter stops and trailing price right after your entry, then you can lower down your Rico size, right? So same way if you do the larger deep liquidity grabs, what I do is I just leave the 135 on all the deep liquidity grabs because I want confirmation that market's going to try to move out of that deep liquidity grab. I don't try to do the lower Rico sizes on it. I find that if these are deep liquidity grabs of the 100 and 200, I find the larger Rico size works good because it's confirming that it's coming out of a zone. I mean, this is confirmation. A lot of traders are doing with it that don't trade the S&P. They're not in the room. We have a lot of traders that don't even log in the room that trade other markets. You know, we have traders trading all types of futures. You can even trade stocks with this. You can trade crypto or Forex, what have you. Let's say you get into the zone and you're coming out of the zone right here. And you're coming out. What traders will do is they will let that 135 print. And then what they're going to try to do is they're going to try to wait until the first liquidity grab comes in the market. And they're going to try to fire in that trade. Some traders wait for the first two liquidity grabs come in the market for confirmation the price is rolling. They'll let the come in. They'll wait for this liquidity grab to come in. That's a first distortion in price. And they'll fire in. They'll buy a little higher for confirmation. Because if you notice, the ones that tend to fail out of the zone on a 135 because it's such a large Renko size, they will fail early on right after you get a reversal in the 35 tick reversal. You know, they'll print yellow and then she'll just fall off. But the ones that continue, they'll just have liquidity grab, liquidity all the way up. The market just keeps adding liquidity and catching the wrongly positioned traders all the way up. So you'll notice that when you come out of these zones. So in other words, when you come out of this zone, instead of printing right away here, you can wait for the first couple liquidity grabs, knowing that you got confirmation. We have traders that do that. Also, confirmation that price is rolling. It's more of a momentum way to do it. But for example, here, you get a reversal inside the zone. This is confirmed the zone's moving. And they'll look for a liquidity grab. And some will even wait for a deeper liquidity grab that is into the price of this original candle. And if it gets within a certain percentage of 50%, 25% inside that candle, then they're going to take that next close. They're going to wait till that liquidity grab closes. They'll wait for a deep liquidity grab, and they get long at 64 for the push up to 72. You know, that's still, you're getting a little bit later in the trend, but what you're doing is you're giving yourself confirmation. We have a lot of traders that love to do that also. So just something that you guys can do if you wanted to. So this morning, I leave this on the 135 in the room. Like I said, you can change to any Renko size you want. But we're looking for a deep, there's our deep liquidity grab from 89.5 to 93, 63, or 64 to 67. All right, so that's how we trade news events. That's how you can trade news events.